Dear viewers, recently I had done a video on are the stock market correction over, are we back in the bull territory? Soon after the release of this video, what we observed was the stock market moved up by 1200 points on one single day on the Sensex. On 8th of April, again we saw the market dancing upwards to the tune of about 500 points. What has changed? Has the bearish view that I had talked in that particular video, has it changed? Are we back in the bullish territory? Let's try to find an answer to these questions in this particular video. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, investment consultant and a financial planner.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, before you watch this video, I would like to add a disclaimer here. Financial analysts like us and the fortune tellers both belong to the same category of people. We think about predicting the future. Whenever we try to predict something about the future, please understand that the events that will follow in future are not under our control. We can make a prediction, we can make guesses, we can arrive at a judgment. But to say that the markets will behave exactly what we have said is something that you should not take it too much seriously. The only difference a financial analyst has from a fortune teller is a fortune teller can talk to you anything and get away with it. The financial analyst has to base his opinion based on the data, based on the experience, based on what he has seen in the past. Based on this, he has to derive a judgment on that. So whatever that I am going to talk to you here, treat it as an opinion. Do not base your judgment exclusively on what I am going to talk to you in this particular video here. Do your due diligence, take appropriate action based on your judgment and not mine. In a marketplace, anything can happen. When the pandemic started, the markets corrected deeply. But in the middle of the pandemic, the markets rallied up to newer heights. So there is no logic for what market can do in the short term. Anything could happen. But markets also have a reasoning behind them. Markets in the long term behaves as per the weightage of the market. Certain conditions have to be met for markets to remain on top or move forward from there. Let's look at what is required for the markets to rally up. The markets rallying up depends on four different factors. Factor number one is the liquidity. That means abundant amount of money is required to provide fuel for the markets to move up. What's happening right now? The central banks are telling that they are trying to curtail the liquidity which is flowing into the market, or they are about to suck back the liquidity. So whatever is that is happening because of the liquidity, the fuel being given to the stock market is in the process of being scaled down or being sucked out. So which will work as an application of brakes for the markets while they are rallying up. The second condition that is required for a sustained rally is low interest rate and a low inflation. What's happening on the inflation side and what's happening on the interest side? Interest rates even today are very low. But the central bankers have already made known their intention that they are ready to start scaling up the interest stage by stage, and in the quarters ahead you can expect the interest rates moving up. When the interest rates move up, in the beginning phase of that interest rate upcycle, markets may not feel anything, but a point will come where interest rates rise will also become a hurdle for the stock markets to climb up. So what we see in this particular case is the interest rate hiking is a certainty. It's just a question of when it will happen, at what gradations it will happen. Whenever that happens, it is going to apply brakes to the stock market. One another thing which is required for the stock market is the low inflation rate. Unfortunately, world over, inflation is raging. The case in point at this point of time in US is sitting on a 7% inflation rate, whereas the interest rate is closer to zero. This is an unsustainable gap between inflation and interest. Either the inflation has to come down or the interest rates have to move up. The chances are both will happen simultaneously. Interest rates will move up and inflation may inch down as per the action taken by the central bankers. When the inflation is rising in the beginning, markets may not feel it because the wages may go up and it may give a feeling that some kind of a wealth is being created. But a point will come wherein which market will run out of the steam, people will get exhausted because of the inflation. It is going to bring down the purchase capacity of the individuals, and it is bound to bring down the stock market. So the inflation becomes sticky and stays here at this level for a long period of time, both because of the inflationary pressures as well as the central bank action due to rise in interest rate as well as suction of liquidity from the market. The stock market is bound to come down in quarters and years ahead. The third point which can propel a stock market up is the growth prospect. Right now, the growth is very good everywhere. It is very good in India, it is good in US. But growth is a function of, as I said, interest rate cycles as well as the low inflationary environment. Inflation, when it's rising, growth comes down. When the interest rates rise, the capital cost will increase and the profitability of the companies come down. As a result, the growth is bound to suffer. So the prospect for growth in future is tepid. Recently, even the RBI governor made a comment that 2023, instead of the growth being at 7.8% as originally projected, could be in the range of 7.2, which means to say that the growth is going to slow down, which will again apply brakes on the stock markets. The fourth point which can propel a market is the sentiments, the willingness of the investors to pour money into the stock market. When it comes to the question of sentiments is like English weather. It can change at any point of time. The retail investor today has, in the recent past, seen the amount of money he has made in the stock market. He thinks that the same situation could continue. With every dip in the market, he is trying to pour in the money and the markets may get propped up for a while. But within the next few quarters or so, the sentiments can give rise for disappointment and things can change very badly. Growth and sentiments are in favor of the market, but they are bound to change within a short span of time. Maybe in a quarter or two, or maybe maximum in a year's time, this may change for markets to apply brake for the upward movement. Make no mistake, markets have run up a lot. The valuations of the market is well ahead of the economy itself. They have run ahead because of the liquidity in the market, because of the hope in the market. There is something called the reversion to mean. When markets run up a lot ahead of the time, either the growth should catch up to justify that particular price, or the prices have to come down. One of the two things will happen. Now the chances are that since the valuations have gone up very high too quickly, the chances of the prices coming down are very, very real. So the reversion of mean will happen at some point of time. As a result, the market may come down going forward. Markets will take cues from the actions of the central bankers. The central banks has a dual duty to support growth as well as to keep the inflation under control. These are two different actions, require two different kinds of handling of the economy. Whatever you try to do to bring down the inflation will curtail the growth. Or if you try to increase the growth, it can fuel the inflation. So when a central bank tries to bring down inflation, it can affect the growth. Or when central banks try to increase the growth, it can fuel the inflationary pressures. Right now, growth is not a problem for the central banks. What is a problem is the inflation. The monster of inflation is there and it is taking a toll. But central banks are worried when they try to take an action to bring down the inflation, will the growth suffer? So what central banks have done is they have taken a calibrated approach to increase the interest rates slowly, to suck out the liquidity in a phased manner. So the central bank's commentary is not accommodative. They have already bitten the bullet. They have said that we are going to increase the interest rate, we are going to suck down the liquidity over a period of time, which means to say in quarters or maybe 1 or 2 years, we will see a sobering effect on the stock markets because of the action of the central bankers. While this is a commentary on the fundamental side of the economy and what is propelling the stock market or holding it back, what is the psychological side of the market? What is the technical view? What is the general public institutions are doing in the market? If I look at the technical charts, what do we see? We are seeing lower tops and lower bottoms. The market made a top around October of last year and it came down and again made an up move. Every time I saw 3 tops being made and all the 3 tops I have ended at about 1,000 points lesser on the Sensex. The first top was made around 62,000 odd levels. The second top came about 1,000 points lesser than that. And the third top, what we saw very recently, ended at about 59,000. The bottoms are also lower than the previous one. We have seen two bottoms and each bottom was lesser than the previous one. We do not know where the third bottom will take out, or will the market sustain somewhere around 53, 54,000 levels. We do not know. Only the future will answer that particular question. So the clear evidence is, when the markets are coming down, somebody is buying. It could be a trader, it could be a retail investor, or it could be just a trading bounce. Anything could be right. But when the markets are rallying, the informed crowd, it could be an institution, it could be a seasoned investor, it could be the experienced investors, they are selling in the market. So when markets are trying to scale the newer highs, the selling pressure is coming. That means the learned people are exiting the market. If this is the case, then why do we see in a few days a market spiking up? Why did the stock market spike up by about 1,200 points on single day? Or why did it spike up by about 500 points on one single day? See, markets require a trigger. When they get a trigger, the market will react to it. Market moved up by 1,200 points because of a trigger. The market got a news of HDFC twins merging into each other. As a result of that, market moved up by about 1,200 points. What is interesting is what happened after this 1,200 points rally. The next 2 days, market gave up the entire gain it made. Likewise, on 8th April, when RBI governor made the announcement that he is going to suck out the liquidity over a few number of years, market took a cue from that and moved up by about 500 points. The markets will invariably react to this kind of a news, and it can give you trading bounces. But every time the market moves up, there is somebody who is selling and the market is coming down. This is creating a volatility in the market. This is giving the early signs that the market could remain low for a longer period of time. So what do I expect from the market? Will the market crash now? Should you be prepared for a crash? The answer to that question is, market may not crash, but what market might do is a slow drift down. When every time the growth numbers come down little by little, or when the interest rates keep increasing higher and higher, or if inflation numbers remain at where they are, market will find hurdles to move up. Over a period of time, market may slowly start drifting down. Right now, what we have seen, the bottommost point on the market is around 53,000 levels. So we saw the rally taking it up to 59,000. Maybe this can become a consolidation zone between 53 to 59,000, and markets may remain here for a long period of time. What happens after that? Will a new cycle commence, or will the market take one leg down and move towards 48,000? Only the future will answer. But it is safe to assume for the time being, market will get stuck between a zone of about 53,000 on the downside to about 59,000 on the top side. That is what we can expect for next couple of months. But over next quarters, or next 1, 2, or maybe over 3 years period, as per the action of the central banks and as per the numbers which come out on the growth side, market is likely to drift down for a prolonged period of time before the next bull run starts. So if this is my opinion, what is that as investors you should be doing? The first thing that as an investor you should know is, what is your time frame that you are doing your investment? If you are doing an investment from a 1 year, 2 year, 3 year perspective, probably equity is not the place where you should look for decent returns. The returns might come from the fixed income side. The returns may come from the precious metal side. The chances of equities giving you stellar returns, what you saw in the past 2 years, may not happen in the next 1, 2, or even 3 years period of time. But if you are a long-time investor, if you have a time horizon of more than 5 years time, you have nothing to worry about what you will see in the stock market from here onwards. A drift down, what I talked about, a slow drift down in the market can work as an advantage for you. You don't need to bring all the money to the equity market in one single day. You will get plenty of time to onboard yourself as a regular investor through a SIP route or regular contributions into the market. You will get prolonged time to enter the market, and you will be in a well position to get the benefit of next bull run whenever that happens. All that as an investor that you have to keep in mind is you should exercise patience. You should curtail your expectations that you will make a lot of money from the equity market in the next 1 to 3 years. Keep your expectations low, increase your time horizon, continue to do what you are doing, and that should be helping you to make good amount of money from the stock markets in the long run. What is that as an investor you should be avoiding at this point of time? You should avoid anything which is not of quality. Most investors do one mistake. They would have been a participant of the past bull market. They would have seen what is moving up, and when these start coming down, they think it is of value. If it is not something of quality, if it is a penny stock, if it is a small cap stock, if it is something which is debt ladder, such companies may not recover whenever the bull market unfolds all over again. So avoid such things which is not of quality. It makes sense to stay in the diversified mutual funds. It makes sense for you to stay with the quality stocks. That's where you should be. Completely avoid the small caps or the mid caps or the debt laden companies. One of the best strategies that you can follow, irrespective of your time horizon, is to carry a multi-asset strategy to invest in the market. Make sure that your investment portfolio has equity, it has debt, it has precious metal, and if possible some commodities also. This strategy should be able to help you to tide over the market cycles which happens because of the interest rate or which happens because of the inflationary pressures. Dear viewers, hope the market commentary that I have done today helped you to understand what might happen going forward from here. If you are a person who is looking to make most out of the marketplace, if you want to design portfolios for you, you can make best use of our services. You can reach to us through a WhatsApp message on the number shown here on the screen, and one of our financial planners in the team will help you design a robust portfolio for you to reach your life goals. Dear viewers, if this video helped you to understand the nuances of the stock market, please like this video. If you are a person who is watching this channel for the first time, or if you are yet to subscribe for this channel, please hit the subscribe button and press the bell icon. Don't forget to share this video with your friends and relatives. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another relevant topic very soon.
Press the bell icon for more details and subscribe our channel.